All right, let's talk about something that's quietly shaking up the entire investment world. We're talking about active ETFs, or AETFs. Now, these aren't just another product on the shelf. No, they're more like a new power tool for investors. They're giving you a level of control and, frankly, introducing an accountability that the industry has been missing for a long, long time. Let's dig in.
So, picture this. You've probably been there or you know someone who has. You've got your money in a mutual fund and the manager is just not delivering. It's that sinking feeling, right? For decades, what could you really do? Sure, you could sell your shares, but that was pretty much it. You couldn't directly challenge the manager or apply any real market pressure. It was just a flaw in the system. But what if all of that is finally starting to change?
And believe me, it is changing fast. I mean, just look at the numbers. In only 4 years, the amount of money in equity ETFs has exploded by more than 15 times. We're talking about a leap from under $20 billion to nearly $300 billion. Wow. This isn't some niche little product anymore. It's a major force that's completely redirecting how investor money flows.
So, what's fueling this incredible growth? Well, researchers at the Bank for International Settlements found something fascinating. AETFs are over 5 times more sensitive to performance than mutual funds. So what does that mean in plain English? It means when an ETF starts doing poorly, investors pull their money out way faster and way more aggressively. And that right there creates this massive incentive for managers to perform, or else.
But it's not just about keeping managers on their toes. There's a direct benefit to your wallet, too. You see, the way ETFs are built is just smarter, more efficient. They use something called in-kind creations and redemptions. It's a bit technical, but the bottom line is it helps avoid those pesky taxable events you often get with mutual funds. And all that efficiency, it translates into direct cost savings for you. On average, ETFs charge about 25% less in fees than their mutual fund cousins.
So this all comes together in what researchers are calling a powerful disciplinary device. It's basically a 4-step process for firing a fund manager. Step 1, the manager starts underperforming. Step 2, investors, and get this, any investor, not just the ones who own the fund, can start short selling the ETF, literally betting against the manager. Step 3, all that short selling pressure forces money out of the fund. And the final step, well, managers who get heavily shorted are way more likely to be pushed out of the industry altogether. It is market accountability in action. And listen, this isn't just some theory cooked up in a lab. We have real-world proof. The research points to a really famous case, the ARKK Innovation ETF. You probably remember it. After a really incredible run, its performance tanked, and it got hit with this intense wave of pressure from short sellers. It's the perfect example of investors using this new AETF structure to hold a manager's feet to the fire. The really cool part is that the impact here goes way beyond just one fund. This new dynamic creates these positive ripples across the entire financial system. It helps weed out the weaker managers, right? Which means capital naturally flows more efficiently to the ones who are actually performing. Research even shows this improves the price accuracy of the stocks these funds hold. At the end of the day, it just raises the bar for everyone. So the next time you hear about active ETFs, remember what's really going on. This is so much more than a new product. It is a fundamental shift in power from the fund managers to you, the investor. It gives you a real, tangible tool to enforce accountability, turning you from just a passive client into an active force in the market. The question isn't if this is going to reshape active management, but just how profoundly it will.